This is a foundation forum. This is our third one. We are introducing this as a program. We're going to try and do 3 or 4 a year. It's just a free presentation of interesting things that we think the community will like. We try and relate it to the Community Foundation, which is a Michigan nonprofit 501c3 organization. Our primary purpose is to match up people who care with causes that matter. So we receive donations from the public, and then we have a grant committee or grant committees that review our grant applications, usually in a quarterly basis, and then we award grants. It can be really hard to choose among grant applicants. We have only a little bit of money that is unrestricted, and then we have donor advised funds where the donor retains the right to select the type of nonprofit that will get a grant from us. So, but we try and support as many of our local nonprofits as we can. Kathy Fitzgerald is here from the, from the museum we support, and Jen Porter was with Haven and now is with Holy Family. So we try and do what we can in the community. If during the program you think of a question and you're too shy to ask it, feel free to contact the Community Foundation after the program. We will either try and hook you up with one of our panel members or answer the question. I love to give answers, even if I don't know the right one. I'm into the gray area, so I'll find something to say to you. So anyway, thank you very much for coming, and I'm going to give the microphone to Tami Salisbury, who's going to lead us off.
Well, thank you, and thank you everybody for being here today. We really appreciate it. As Joe said, I'm Tami Salisbury. I'm their development consultant here at the foundation. And yes, we started these foundation forums, and it's so great to see all these people that are interested in the topic. So at the end of today, later today, you're going to get a survey, and we would really greatly appreciate your feedback on today's program, as well as any ideas you might have for future programs you might want to attend. So you'll get that. So with that, we're going to get started, and I want to thank Katie, Collin, and Chad for being here. We greatly appreciate it. And we're going to start off with just giving us your kind of background, and I'm going to go with ladies first. So Katie, if you want to start us off, sorry.
All right. My name's Katie Peabody. I work at Fenner, Meldstrom & Dueling. I am a certified CPA. I've been in the public accounting space for the last 15 years. My specialties are closely held businesses and high net worth individuals. So my passion is tax planning. I used to tell my folks that I love the law, but I really don't love paying taxes. So we went into tax law. So I'm not an attorney, but I am a CPA. I have 3 wonderful children who keep me on my toes constantly, 10, 7, and 4. So I have a very busy life, but I love what I do. And so, we love to travel around. My kids tell me that all I do is clickety-clack on the computer, and then I talk to people on the phone, so they really have no concept of taxes or anything that I do, so I love that. But their daddy's a mechanic, and so his job's way cooler than mine. So they're all going to be mechanics or race car drivers. None of them are going to be accountants, but hopefully you all get something out of this. If you have any questions, we're here to help and share what we know.
Okay, and Collin, you want to go next?
Yeah. Yeah, thank you guys. Thank you everybody for letting me join you guys today. Collin Dickey, I'm the lead attorney and the owner of the Dickey Law Firm. Born and raised in Rochester. I've got 3 little boys myself, so we're definitely a crazy household in my house as well. But I focus on estate planning, elder law, and probate. Estate planning, wills, trust, powers of attorney. Elder law is a little bit more complex asset protection planning. And then probate as well. Born and raised in Rochester, went away to a small school in Virginia, Hampden-Sydney College, came back for law school, attended Thomas M. Cooley Law School, met my wife there. She spent 10 years as a litigation attorney. She's now taken a step back from that and helping me a little bit with my firm doing probate. So, and she's made it very clear I'm not her boss. So if anybody asks, I'm not her boss. But she helps with the probate end of things. Actually, out of law school, I was at a financial advising firm for a couple of years. So within a financial advising, I did a lot of compliance, a little bit of tax law, and then I did a lot of estate planning reviews. While within that capacity, I found that a lot of those estate planning documents weren't really doing what the families thought that they were accomplishing. So it led me to want to practice more on the front end, help draft these documents and help families in a different capacity. I know I look like a spring chicken, but I'm not, I'm not anymore. I've been doing this about 10 years, or actually a little over 10 years at this point. So and that's what I've been doing my entire legal career. Is estate planning, elder law. I love it. I help people in the long run, but I help people sleep better at night as well. A little bit more about me, just for 10 more seconds on a personal end. I like doing things outside. I like fishing, golfing, tennis, doing things with the kids and the family who love to travel. But again, I appreciate you guys allowing me to speak here today. The Community Foundation is a great organization, and if you're not familiar with it enough, I highly recommend getting a little bit more versed with it. So, but thank you.
All right, Chad?
I guess last, huh? Good morning, all. Welcome. Happy to be here this morning. Happy to provide some insights. So, as Tami said, my name is Chad Rinke. I'm a financial advisor with Edward Jones. My branch happens to be walking distance from here, just north. Didn't walk this morning. A little bit worried about the rain. So it doesn't go great with suits either. So decided not to make that walk this morning. My hair is fine. My hair is going to be fine in the rain. Let's be fair. Yes, yours get curly. Mine does too. So been in the financial advisor role since 2002. So I began my career at Edward Jones and continue to run a branch here in Rochester. I grew up in general area. I'm from Romeo. Went to Adrian College, a small school down in southern Michigan. Had an opportunity to play 4 years college baseball. Certainly a great experience as well. My practice is focused, similar to Katie's, on closely held small businesses, and also we've had a lot of success lately helping what I would call the newly single, divorce, widows, widowers, those sorts of opportunities. I have 3 children, Patrick, Harrison, and Quinn. Patrick is 13. Quinn and Harrison are twins. They are 10 tomorrow. We are a big athletic sports family, so we do spend a lot of time outside between baseball and soccer, and in the winter we're inside with basketball and all the other lots of great activities. So excited to be here today, excited to share some insights on the investment side of all of this and ways that you can take advantage of some of the great things that are out there for you.
All right. Well, you can tell I brought the experts. So we're just going to get started here, and our kind of first topic is going to be on qualified charitable distributions, also called QCDs. So if you see that those initials, that's what that is. Chad, can you talk about QCDs and who can use them and how?
Yeah, great question. So I feel like our industries, the 3 of ours, come up with these crazy acronyms and terms that we have to explain a couple of times. So qualified charitable distribution, or QCDs. There's a handful of just like bullet pointed things that I want to share with you first, and then we can talk about some real world examples and things like that, if that's okay. So that's how I thought I'd kind of start today. So the basics of QCDs. Again, our industries and our and rules and regulations come up with some odd things. So the first of those is you have to be 70 and a half. And it can be used towards what's referred to as, another one of our funny acronyms, RMDs, or required minimum distributions. So that's rule number 1. They can be made from your traditional IRAs, rollover IRAs, inherited IRAs, or other types, right? So that's kind of another basic. There is a maximum. So that maximum that you can take advantage of with a QCD is $108,000. It's a limit for both individual and joint filers. That may have changed though, so I'll let Katie talk through that with some of the new tax law changes. The benefit, so when I think about the benefit to your QCD and why you would do that, because the way I think about your required minimum distributions, that's the money that every single year the IRS tells you you're required to take out of your IRA when you hit a certain age, or if there's an inherited IRA, so a non-spouse takes over an IRA, if you've reached that 70 and a half, that money can be sent directly to a charitable organization and not count towards taxable income. So as long as you send, I'm going to say that again because that's a really important part of it. You have to be 70 and a half. It has to be sent to a qualified charitable organization, and that's why it's not taxable if done that way, right? Is the point I was trying to make there. I've seen that done incorrectly, and I've seen it done correctly. When done correctly, very straightforward, very simple. When done incorrectly, it's really not a whole lot you can do to undo that. So that's kind of the basics in my notes about QCDs.
Can I add one point to that
Sure,
on the
please.
taxability piece? So, as he said, it's when you have the QCDs, you have the deductions that go straight to the charitable contribution or charitable organization. It's not taxable, but it's not taxable in a different way than a normal charitable contribution would be. Normal charitable contributions you take as an itemized deduction or something like this. This is a direct exclusion from your income. So we would show, IRA distributions of $50,000, but then the taxable piece of that would be zero. So it is a direct exclusion from your taxable income rather than going through itemized deductions or something like that that could be limited or carried forward or things like this. This is a direct dollar for dollar. It just goes away. It's reported, but it goes away.
That's a great, I'll add not to that, but you made me think of something, Katie, so thank you.
I'm here.
So when I think about those required minimum distributions, the way I talk about that to clients is there's three things you can do with that money. So the IRS is going to tell you you have to take this money every single year when you meet a certain age. And there's three things. We can send it to you and you spend it and go do something fun. It's great use of that. You've worked really hard for that money, so why not? Maybe I don't need it today, but I might need it tomorrow. You can reinvest that required minimum distribution in a different account. Or, to Katie's point, if you send it directly to a charitable organization that qualifies, it doesn't count towards income. I've asked clients to reframe their reference in terms of giving. So an easy example that I have, a real world example that we've talked about, actually impacts the foundation. So if you know the foundation has a lot of different funds within the organization. One of those is the Women's Fund. So the Women's Fund is one of the oldest standing funds at the foundation. And I have a client that brought it up to me probably 10 years ago that asked the simple question like, hey, I'd like to give more money to the Women's Fund. Is there a way for me to do that? And I said, here's a great way for you to think about using that money in a way that might be different than the traditional way of giving. So reframe the reference or reframe the giving, the way that you give because of what Katie just said, right? It's the opportunity to think different. If you're already giving, outstanding, but maybe think about how you do it in a different way to make it more impactful to your tax return. I think it's our patriotic duty to pay the least amount of taxes we possibly can. Yeah.
And the charity that you pick must be acknowledged by the IRS as a qualifying charity. So there's great causes out there, but you really want to do your homework when you pick a charity. And I'm guessing when you guys are advising and when they review before they do as designated, you make sure that charity is a qualifying charity. So great. All right. Oh, you give it to 2?
Yeah, great question. Yes, you can give it to 10. There's no limit on the number of charitable organizations that can benefit from the QCD. You also can spend some of the money yourself if you'd like, right? You can do a combination of all three of those. It's not you must do one of the three. You can choose to split it up. I've split it up between a client's church and a different organization.
Tami, could they give it to the community foundation and have them?
Yes. Yep.
So,
yep.
well,
Yeah.
Okay, maybe. I didn't know.
Yeah.
yes and no, but I think that's one of your questions later on, so I don't
Yes.
want to steal this
Yeah,
really
yeah.
excited. I'm going to let it build
Yeah.
out there for you to think and ponder. But to answer your question specifically, ma'am, yes, you can.
The great part about QCDs is how flexible they are. I mean, you have to do it right, make sure you're following the rules, you're not stepping into quicksand that you don't know is there, but there's so much flexibility that goes along with those as far as the charities you want to give to, how many charities you want to give to, when you want to give to them, but also it doesn't have to be your whole RMD. There's there's many different methods that you can go about maximizing that charitable contribution and keeping it out of maybe some of your other charitable contributions that might be limited. So it's a really, really powerful tool. It's great to be able to utilize and take advantage of.
Right, and just one final point on this is the required minimum distribution. Sometimes they give you checks, and that is not how it works. You cannot use those checks and give that to a charity. It actually has to come through your financial advisor. It has to be directed before the check is cut to you, your minimum required distribution. I just want to be clear on that. That's a really important part because, sometimes they give you checks and you think you can write them and then you're like, well, wait a minute, why can't I write this off? You cannot. It has to, Joe, you can.
Well, for those who have a book of IRA checks from their administrator, they can write a check from that book directly to the community foundation or another nonprofit that does qualify. Just make sure you get a letter from the nonprofit indicating that you received that distribution, because typically with a distribution, the organization knows that the check's been sent. There is a end of the year kind of trap that you think you're sending on 27th and you're good to go, and it's not received and processed by the 31st. It's a distribution in the following year. So we have a couple of different regular donors who would actually have checkbooks for their IRA account. So, but if you are requesting it from your administrator, then yes, the check needs to come. Well, they can mail it to you in but again, it needs to be made payable directly to the community foundation. It's made payable to you as an individual. It's not going to matter even if you send it on to us.
Yep. All right. So we're going to move on to the next topic, okay? This is talking about donating appreciated stock. Donating appreciated stock offers advantages over donating cash. So, Katie, what are the tax benefits of giving stock over cash, and what are the requirements?
Yeah, so there are a lot of benefits of giving appreciated stock over cash. One of the biggest benefits is that you get the full charitable contribution deduction for the full face value of the stock when you give it, not the basis of when you bought it or when it was gifted to you. You get the full value of the stock for the charitable contribution. The organization gets the full value of the stock as receipt, and you get to defer, or not defer, but completely eliminate the capital gain that would have been recognized had you just out and out sold that stock and then taken that cash and given it to the charitable organization. So it's a great tool to be able to say, I've had clients who, worked at the big three, had stock, they've been sitting on it for a very long time. It's worth considerably more than what they had, and being able to gift that stock over. Maybe they have $5,000 worth of basis. That's what they paid for it. And now it's worth $100,000. They don't need to pay tax on that $95,000 that it has appreciated. The organization can take advantage of that. They have the value of that. They now have the basis in that. And you get the deduction for the $100,000. So it's a really, really great tool. There are limitations on the stock gifting that aren't on cash. The limitation for stock gifting or capital assets is 30% of your adjusted gross income. Another one of those acronyms that we love, three-letter acronyms, AGI. So the 30% of your adjusted gross income is the max that you can donate in appreciated stock in a year. It resets every year. You can do it again. But you really want to make sure you kind of know what your income number is first before you gift the appreciated stock. Yeah?
Are you talking about just a district getting the appreciated stock from a tax sheltered IRA, or are you talking about any appreciated stock?
Any appreciated stock.
Well, so you wouldn't take it from the IRA because that's pre-tax dollars. This is after-tax dollars. So imagine if you bought Microsoft or NVIDIA or any of the what the media's dubbed the Mag 7 3 or 4 years ago and they've appreciated 200% in a very short period of time. That's a very recent example, but it's got to be an after-tax, non-IRA
So in other words, a brokerage account, an investment
Brokerage
account,
account, yep.
a non-retirement. Yep.
Yes, the IRAs, we can use the QCDs, we have other mechanisms for that, but this would be appreciated stock that you hold. It's a wonderful tool. If you do exceed that 30% limitation that I talked about, it doesn't disappear forever. It does get carried forward. You can utilize it in the next year. You have 5 years to utilize that. So I do have some clients who are like, I don't want to do the math, and they just, they give whatever they want to give, and then it's my job to make sure it gets utilized in the next 5 years. So that is a really, really powerful tool. The limitation for cash gifts is 60% of your adjusted gross income, AGI. So there is a significant delta there, but the value that you get from not having to pay tax on those capital gains on that asset is huge. It's great for your estate planning, gets that money out of the estate planning, it gets it to your charitable organization of your choice, and so it is a very, very powerful tool. And if you haven't been able to tell by now, the CPAs, the attorneys, and the financial advisors work very, very closely together because what he does affects my job and what I do affects his job. So having a great team with you, you can maximize what you're doing, what your goals are, and make sure that your goals are being met.
All right, so that segues right in to Chad. How can you execute that stock donation?
Yeah, great question. So it's a process that when you're sitting on our side of the table is a simple process. When you're sitting on the other side of the table, it may not seem so simple. So the very first thing that if you picked up the phone and called your advisor, you're gonna need to find a DTC number from the organization that you're sending the money to. So a DTC number is, Edward Jones has one, Merrill Lynch has one, Morgan Stanley has one. We all have them, and it's a way to move stock from one firm to another and pick specific shares to do that with. So might seem complicated on the other side of the table, but for us, it's an easy process. So I have a couple of clients that will move shares out of Edward Jones because the firm that's going to sell the stock, because someone has to sell that stock so that the charity can benefit from that. We've moved it out very simply, and we can move it in very simply because I also have funds at my office that are for charitable organizations that I process those stock sales for them. So it's a pretty straightforward process. So where you should start is just pick up the phone. And then they'll have some questions, some ways to do that. So that number one thing they're going to ask for, and you're going to need where the money's being transferred to, you're going to need that DTC number, and you'll provide that to your current firm.
Can you provide us a real, I'm sorry, go ahead, you finish.
I was just going to say we should have made bingo cards with the acronyms that we were using today so that, we could have had prizes.
Yes,
and
that's right.
I'm not
Yeah,
even
we'll
gonna get
have to
into
have an
mine,
index next time.
Yeah, we've got some cruts and different stuff coming up here in just a second, don't we, Collin? Yeah.
A little bit.
So real world example.
Yeah.
So Katie did a great job of explaining that in terms of the why behind that. You have a cost basis of $5,000. It's $100,000 value today. That's a $95,000 capital gain. 15% tax on that, right?
20%.
20% tax on that now. Thank you. That's why we bring professionals on the tax side with you. So real world example, I've had a number of clients that have highly appreciated stock. In this example, I said Microsoft earlier. They bought Microsoft at its IPO. So they've held it for quite a long time. That was before me in the industry, but we've developed a relationship. They've transferred those shares in. They're held in their own little account. We call it the Microsoft account because we don't want it to be commingled with anything else. Every year, they'll actually send it to 3 different organizations. So great question earlier about the QCD. Same idea here. If you have highly appreciated stock, it can be sent to a number of different organizations. Mr.
Chad, I'm sorry, but I would just ask that you change your adjective. It's not its own little account. It should be its own large
It is its own
Significant
significant account that is part of a bigger account relationship, but it's a significant account that every year it's a very simple process that they are gifting these shares of Microsoft that basically have a cost basis of 0. So they would pay taxes on every dollar of it, and that's why they're doing it. And they're also charitably inclined, and it's a great way to benefit that charitable organization.
Great. All right. So next we're going to move on to a new topic, reducing the tax burden through strategic giving. It sounds like we've talked about it all, but we haven't. So, so strategic charitable giving can be a powerful tool to reduce your tax burden while supporting causes you care about. Katie, what trends are you seeing in tax policy, especially new ones, as it relates to philanthropy?
Yes, so I got the privilege of preparing for this meeting and then having new tax legislation come out less than 2 weeks ago. So I got to prepare again. So I get to present to all of you on 2 different sets of tax legislation and 2 different sets of rules, and just make everything hopefully as clearer than mud. So for 2025, the year that we're sitting in right now, not a whole lot has changed as far as the tax legislation. So itemized givers, people who exceed that standard deduction, that was increased this year, so that's a little bit of a change. But those of you who exceed the standard deduction with your charitable contributions, with your taxes, with all of the things, mortgage interest, all those things that go in there, those charitable contributions are going to be able to be utilized the same way that they always have. You get the deduction, the standard or the itemized deduction, as long as it exceeds $15,750 if you're single, $31,500 if you're married filing jointly. If those itemized deductions, the charitable contributions exceed that, then you'll be getting that benefit. One of the things that we encourage our taxpayers to do is to bunch their charitable contributions, because we have very charitable, very giving folks that will give maybe $5,000 a year, $6,000 a year, but they never exceed that limitation for the standard deduction. So while it's wonderful and that charitable contribution is fantastic, our suggestion to them is maybe take 3 or 4 or 5 years worth of charitable contributions that you would be giving to them and front load it. Give it all at the same time. So then that bunching of the deductions will push you over the itemized limit. You'll get the benefit on your tax return. The organization gets the money sooner, and we can utilize that tax strategy so that, not that they're going to waste, but that you can utilize the deduction. Again, I talked a little bit about the 60% limitation and the 30% limitation on your adjusted gross income. So we want to make sure that we're calculating those type of things. But again, you can carry over the excess and make sure that it's utilized in a future year. So that's always important. Making sure you're timing your deductions correctly. Like we said, please don't write a check on the 31st because it's probably not going to get processed at the New Year's Eve party. So please give those organizations time to process it and deposit that check and get you your letter saying thank you so much for your charitable contribution, because that is an important part to show when the charitable contribution was made and what tax year to apply it to. So 2 weeks ago, we had new tax legislation that just came out. Obviously, my profession is drinking from a fire hose, so we are learning very, very quickly. But for 2026, charitable contributions have changed significantly. So for next year, as of January 1st next year, taxpayers who don't itemize, those that are just going to take the standard deduction, are eligible to take $1,000 in charitable contributions or $2,000 if you're married, an above the line deduction. So you don't need to itemize, you get that deduction. You can give that to whatever charitable organization you'd like. Again, it has to be a qualified charitable organization, but those taxpayers that might not necessarily exceed that line can give up to $2,000 and still receive full deduction for those charitable contributions. We saw this on a smaller scale back in 2021, everything blurs together with COVID, but it was a $300 deduction that you could take above the line. You didn't need to itemize, and it was a way of just kind of stimulating giving to our charitable organizations. The new tax legislation that just came out increased that number, brought it back, and increased that number for our non-itemizing taxpayers. So I think that was a great part of the bill. I think it's a great way for organizations to be able to market on that opportunity and really be able to allow people to get the bang for their buck and be able to use that deduction that might have otherwise been lost. So this year, I'm encouraging my clients to bunch charitable donations. Next year, I will switch up the strategy a little bit and see they can give $2,000 every single year, and then we'll bunch the rest. So also coming in 2026 is a limitation on a floor on charitable contributions for itemized filers. So for 2025, every dollar that you give to charity is deductible, whether it's carried forward or in one shape or another. In 2026, there will be a charitable contribution floor. The first 0.5% of your adjusted gross income will not be allowed as a charitable contribution. So if you make, I'm going to do math on the fly, $100,000, 0.5%, we're talking $500. I think I mathed that correctly in my brain. The first $500 of your charitable contributions will not be deductible. So if you make a $10,000 charitable giving, you will get a $9,500 deduction for that, for itemized filers. That floor that's not a thing for non-itemized filers. It's only for the itemized folks. And so that's going to be a little bit different for tax planning. The higher AGI you have, the higher that 0.5% is calculated. So QCDs are going to be beneficial because that doesn't go into your AGI. So, the tax planning strategy there is going to be a little bit different. That starts in 2026. The other change to itemized deductions is for those taxpayers that are in the 37% tax bracket, that's the very highest. It starts around $720,000 of AGI. Those folks, their itemized deductions are going to be limited to 35% of their total AGI. So that was a limitation that was early in my career. It went away for a long time, and it's been resurrected with a different name, but there will be different limitations on all of your itemized deductions moving forward in 2026. Yeah?
Katie, you said that there's a limitation on 30% of your AGI if you're gifting appreciated securities. This is separate from that. This is just a hard ceiling on all gifting?
So that fire hose I was talking about, we're still drinking from that, and there's a lot of regulations that need to come out. The way the rules worked before, it limited some itemized deductions first before it touched your charitable contributions. We're not 100% sure right now how that's going to work, but to your point, if you're in the 37% bracket and appreciated stocks limited to 30%, and then totals were limited to 35%, and then if you get cash, it's at 60%. So we've got about a dozen different limitations that we need to find out what the pecking order is on all of those. So if you find that yourself in that situation where you are, tax planning will be important. I mean, I love it. It's fun for me. But tax planning is going to be important because there's going to be a lot more moving pieces than there has been in years past.
What I just heard from Katie is if you itemize your return, schedule an appointment between now and the end of the year with your tax preparer, sooner than later.
Come talk to us. But that is 2026. So 2025 is pretty status quo, but yes, it will.
Yes,
it's a thing.
It's just emphasize, and I host a couple of workshops of my own, and at the end of my presentations, I go, it's important to work with a professional not only because they know the rules but we keep updated on them. They're constantly changing. So even if you think you know it, you may know it now, but changes. So, yeah.
Constantly. Great. All right, so we're going on to the next topic, and we actually brought this up because it was one of the questions, and it's on 529 accounts. So this is a little bit of a shift that we're going to talk about, but it's an important topic. And so this is when you are saving for future college education, or even if they go to a private school, those could be used. Anyways, so that's essentially what we're talking about. So Katie, can you describe legacy uses of 529 accounts and when it's the right strategy?
Yeah, absolutely. So this is one of those topics where we're going to be working together, because 529 accounts are not they are not charitable contributions. They are not deductions on your Schedule A or above the line or below the line. They are not a charitable contribution. You are gifting for the future benefit of a loved one, a relative, a friend, of a goddaughter or son. So they are not charitable contributions. They are not going to be a deduction on your federal return. So a lot of people are like, well, what's the point? It's a great plan. It really, really helps out our kids, and it's a great tool for you all as well to be able to get cash out of your estate, let it grow tax-free, and then have that benefit for your children, grandchildren, nieces, nephews in the future. So I just want to make that clear. So states do allow a deduction. Michigan does allow a deduction up to $10,000 for gifts to those 529 plans. So on the state side, you will get some benefit on your tax return, but it is not a federally deductible charitable contribution. So just putting that out there. There's a couple different plans. You can have a single beneficiary 529 plan or a multi-generational or legacy 529 plan. There's options, but the mechanics of it is that you gift into this account. You designate a beneficiary, either yourself or a loved one, and those funds are deposited. They grow until the child needs them, and they can be withdrawn for educational costs. Traditionally, when they first came around, it was secondary education, secondary colleges, trade schools, things like that. It has been expanded. Again, this changed with the tax law too. So it has been expanded so that you can use it for K through 12 educational expenses, certain educational therapies for children with disabilities, tutoring, books, things like that. For 2025, the amount per beneficiary is $10,000 per year. For 2026, it's $20,000 per beneficiary per year. You can also use up to $10,000 of that for student loan payments. So if you have a kid, I have a client who has a granddaughter that they want her to take school seriously. So the plan was she was going to take student loans, and she was going to pay for her own schooling, and then when she did well and she got through school, then they were going to use that $10,000 a year to start paying off those student loans for her. But it was a way for her to take responsibility for her own schooling and then get the deduction. So that is new. They can now use $10,000 towards student loans. It's a really great tool, but like I said, it's not necessarily going to reduce your federal tax burden immediately. It might one day, but not immediately. So there's a lot of things you can do with it. I have an account for each one of my children, and it's just a little bit of security. I paid off student loans for 7 years, so wanted to help out my kids. So
Yeah, and
Can I
Yep.
add 529 stuff? So there's some nuances to the 529s that I'm really excited about. And this one has been around for quite a while. If it's held in grandparents' name, it's better for the students when they're going through the process of financial aid. So that's a good benefit if it's held in grandparent name. So the titling of a 529 is a little different than a traditional account might be. You have the owner of the account, which could be candidly anybody. So grandparent or parent is most common. The beneficiary, this is the part that's a little different. The beneficiary is the person it's going to benefit. And then you can add a contingent owner to that. So that contingent owner, if it's a grandparent situation, is grandma or grandpa, beneficiary is grandchild, contingent owner is typically their son or daughter or their in-laws, right? So that's a really important part of it. And to Katie's point, any higher education expense, beauty school, trade school, all of those all play into that. And part of the Secure Act, which is Secure 2.0, it was written into that. If the child doesn't use it all for education purposes, it can be converted to a Roth IRA for said child. It can also be moved through generations.
Yes, which is a very powerful tool. A little quirk nuance that they added into that Secure Act is that you can't then later use the converted Roth for a QCD, but we're talking 50 some years ago down the road, so who knows what the tax law is going to be at that point. The other nice part is everybody gets an annual exclusion for annual gifts. You get to give to anybody, anywhere, a certain amount, and it doesn't go against your lifetime exclusion amount. 529 plans have a nice ability where you can front load 5 years worth of annual gifting, give it all in year one, and then spread that out over 5 years. So you can get the money in the account, start it growing now, and then take that annual exclusion over the next 5 years. And that can be a nice tool to be able to get money out of your state, get it working for you, but not have to exceed any limitations where you might have to pay gift tax or things like that on there.
Yeah, and I had my, all of my mom and dad and my husband's mom and dad, instead of getting lavish gifts for birthdays and Christmas, just start a 529 account. And I'll tell you, I had a son just graduate, and it was a godsend because college expenses are going up so astronomically, and it really helped us get over the finish line. So anyways, I thought
One more thing, if for some reason you decide you don't want the money in that account anymore, you can take it out. There is a 10% penalty, like early withdrawals from your IRA, but it's not lost forever. You can take it out, but it's there. Or you can just change beneficiaries. You can just switch that up a little bit. So it's up to you.
All right. So we're moving on to our next topic, which is estate planning. So estate planning offers powerful strategies to incorporate charitable giving, allowing individuals to leave a lasting legacy while potentially benefiting from tax advantages. So Collin, can you talk about the many tools that we utilized in estate planning?
Yeah, for sure. Thanks, Tami. And Chad here and Katie have talked on lifetime giving. You know, these are all lifetime giving, and I'm kind of now going to turn the page a little bit to planned giving, you know, things that maybe you do after you've passed and so forth. But before I dive into that, you know, I always like to give an estate planning 101. You know, sometimes a basic understanding of some of the major documents that come into play sometimes set the foundation. So just to kind of give everybody a little bit of a bigger picture here, I'm going to take 1-2 minutes or so to just kind of give you that 101. So, you know, when you talk about estate planning, there's 4 major documents essentially that come into play. There's a financial power of attorney, a healthcare power of attorney, a will, and a trust. Financial and healthcare power of attorney is a document that allows you to designate someone, such as a spouse or a child or a friend, to help make medical or financial decisions on your behalf in the event you're unable to do so. You know, everybody thinks estate planning, this is once I'm gone, right? Well, no, we need to plan for incapacity as well, because a lot of times, you know, no matter how close you are to your spouse, no matter how close you are to your kids, if something were to happen to one of you, unless you have these simple documents in place, somebody is now going through court. Somebody's going through court to be assigned as a guardian and conservator. So having a financial and a medical power of attorney documents in place goes a long way. On the financial side, that could be as big as, you know, buying and selling of a house and some of the things that we're talking about here, to as simple and silly as paying the cable bill and then everything in between. Signing a tax return, exactly. On the medical power of attorney side, that's being able to talk to doctors in and out of nursing homes, you know, those types of decisions. So again, very important to have in place there. All right, once you're not here anymore, that's when a will and or a trust comes into play. What is a will? Everybody knows what a will is. A will is a way to distribute your assets upon your passing. However, one of the biggest misconceptions with wills, and that I hate telling the families that I work with, is that a will does not avoid probate. Probate is that court litigation process that you essentially have to go through in order to actually receive those assets, actually distribute those assets. One of the biggest reasons why people go through probate is for real property, a house, a home, a condo, an up north house. Probate on average is about 18 months and costs anywhere from about 5 to 10% of the value of whatever we're talking about. So it's very time consuming and very costly. Just to use a round number, let's say you've got a house worth $100,000. Probate could cost anywhere from $5,000 to $10,000 to go through that probate process, and then in 18 months for the kids to go through that. So how do you avoid this, right? You avoid this through trust planning. One of the biggest advantages of creating a trust is that it completely avoids the probate process. I say as an attorney, when I create a trust, it's almost like creating a suitcase. We create this suitcase and then we pack it. We pack it with everything we have. We pack it with the retirement accounts. We pack it with the savings accounts, the house. And that way, when something happens, that suitcase is easily transferred to, a charity or the next generation or whomever you want it to go to, completely avoiding that probate process. Okay, that's the biggest advantage. I'm going to hit two or three more points, but they're very, very high level here. But it avoids probate. It's a private document. Sometimes this one hits home with people and sometimes it doesn't, but with a trust, it is for you and your eyes only, and then the eyes of your beneficiaries. When you go through probate, that is all public knowledge. Anyone can look up who got what, who didn't get what, how much they got, and who got left out. Aretha Franklin, Prince, Robin Williams, these are all big examples of people we know everything about now because they went through probate. How? I don't know why they didn't have a trust, but that's a different topic. And so it avoids probate. It's a private document. You could be a lot more creative in the distributions as well. Third point is you can say, you know what, I want my grandkids to receive the assets, but only for their needs until 25 or 27 or whatever it is. So you can be a lot more creative in how and when those distributions go to those beneficiaries as well. Fourth and final major benefit to trust planning is that there's a protective value for your beneficiaries as well. For instance, I hate mentioning divorce, but divorce is a real thing. If your kids or your beneficiaries are going through divorce, that suitcase acts as an extra barrier protection against those types of situations. So a trust protects your beneficiaries from divorces, bankruptcy, creditor, whatever's happening in their lives at that time, that suitcase helps protect those assets. Okay? That's my quick 101. So now, now I'll dive in. Yeah, I appreciate it, because I think that helps set a foundation a little bit for. All right, so what we're talking about here today, planned giving. They have touched on a lot of lifetime giving strategies, but there's also a lot of planned giving strategies as well. And there's a couple of different advantages to different routes, just depending on what your goals are. I say, isn't it? Sometimes people like me saying this, and sometimes it doesn't. But as an attorney, I don't like telling people what to do. I like to tell people, hey, what are the pros and cons? These are what these documents do, what they don't do. And ultimately, it's trying to figure out what your goals are, what you're trying to accomplish. So sometimes those goals are for tax planning. Sometimes those goals are for, making sure that your family's involved with your decisions. Sometimes it's in ensuring your favorite charities are taken care of. So it just depends on what we're trying to accomplish. But bequests, within trusts, you can, of course, add a charity to a trust or a will, and that is one way to make sure that those assets are distributed to a charity or foundation that you would like to provide for. Even simple as setting up beneficiaries to accounts that you already have. So for instance, life insurance policies. Let's say you've got an old life insurance policy that's still around. You can add a charity or a beneficiary to that as well. A retirement account, an IRA, a 401k. There's a lot of different, donor advised funds as well. And then there's certain types of trusts as well. I mean, we can create something called a charitable remainder trust. I'll stay away from the acronyms. So, but a charitable remainder trust, which has a lot of tax advantages to it during your lifetime, and then it allows you to provide for a charity that income produces the income that trust produces can provide for the charity of your choosing, and then you could put a beneficiary onto it as well. Or I'm sorry, I think I did that in reverse. A charitable remainder trust allows you to give the income during your lifetime to either yourself or a beneficiary, and then upon your passing, it can have that asset go to a charity. And that's what a charitable remainder trust is. Yeah, and again, I think, Katie and Chad here have already touched on kind of the importance of figuring out a strategy. There's so many routes that you can take. Having a professional team in place goes a long way. Even just a simple conversation with one of us kind of allows us to understand what your goals are and what route may be in your best interest. But we're the experts here, and I like to think that anyway. And talk to us on kind of what you're looking to do, and we can figure out the best route. So, thanks.
All right.
Yes. Or yeah. Sure. Oh, well, the question is there a benefit to putting an IRA in a trust? And the answer is it depends. That's the lawyerly answer, right?
It's a very accountant answer of you.
Yeah. So there's pros and cons, and that's a great question, and that's a great conversation that I have with the families that I work with. And so one of the biggest advantages of putting an IRA or a trust as a beneficiary to an IRA is that has that asset then flow through the trust, which is great, right? Well, what are the advantages of the trust? Then it covers essentially all the ifs, ands, and buts. So if you have a beneficiary going through bankruptcy, or if there's a contingent to that beneficiary, you're getting again all the benefits that trust provide. Now there's some different tax consequences that could potentially pop up. So that could be a disadvantage. Depending on how the trust is drafted, for instance, I draft trusts in a manner where it allows you to stretch out that pulling out of that IRA, then you can stretch out that pulling out of the IRA. So again, I'll give you a quick story. I had a woman I was working with who had an IRA. She had about $250,000 in the IRA. She named her grandchild as the beneficiary. She wanted her grandchild to receive the assets. She did not have a trust in place. When the grandmother passed away, and this is a true story, when the grandmother passed away, unfortunately, her grandchild was going through bankruptcy. So what do you think happened to that money? Went right out the door, right? And Chad, what's different about retirement accounts?
All taxable.
It's all taxable.
Not only was he going through bankruptcy and lost all the money, but he had $250,000 of taxable income
as well.
That hit
so
his.
He lost the money and owed the taxes on it. That's exactly right. Now, wouldn't it be nice if there was a way to do something a little bit more strategic in a manner where it covers all the ifs, ands, and buts, and that's through trust planning? Yeah. Yeah, did you have something to add? Or?
No.
Yeah. Yes, ma'am.
So two questions. What's a lady bird something or other?
Yeah.
And should you be putting your mortgage, your house inside of a trust? I've been told you should.
Sure. My answers are all going to have a theme to it. It depends. So her question is what is a ladybird deed, and should your house go into a trust or not? Correct? And so the quick answer to a ladybird deed is an estate planning tool that essentially allows us as attorneys to put a beneficiary to your house. What it allows you to do is to say, all right, Collin, you own your house, and if Collin does not sell his house before he dies, then it goes to X. And X can be a trust, X can be a charity, X can be a family member. And so I use ladybird deeds a lot. However, it depends on, a lot of circumstances. I have families who do certain types of asset protection planning, and maybe we don't want a ladybird deed now. Maybe we want that trust or that home in the trust directly. So we don't do a ladybird deed. We do what's called a direct transfer. And so we put that home in the trust directly, not through a ladybird deed. So, again, I guess that's a tough question to answer, but it really just depends on what type of a trust you have. Do you have a trust? There's not a lot of disadvantages of putting a home in a trust. Sometimes title companies throw a little red flag saying, oh, I see that this home is in a trust when you try to sell it. You just have to provide extra proof that you have the ability to sell it. But not many times is it, there's not a lot of disadvantages to putting a home in trust because, again, the probate avoidance, having that ability to protect the assets, a lot of times the benefits greatly outweigh the little hang up you may have on selling it. Yeah. Yes.
Sometimes the mortgage companies get a little fickle about that and
Yeah.
had a mortgage that could trigger some.
Yeah. Yeah, so good question, good point. I have a lot of families who end up calling me back, say, hey, I've got, Flagstar Bank or X Bank, that says they don't like the Ladybird language on here. What do we do? We literally just take it out of the Ladybird deed, go through the home equity, go through the mortgage, go through whatever we're going through, and then immediately put it right back into the Ladybird deed for that probate avoidance and things like that. So there's definitely things you can do. It just depends on the bank, or the institution, but there's some that don't like that, and we just do a quick and easy fix for it, and then we put it right back to where it was. So, yeah. Yes, ma'am.
Are you talking about a number of trusts, like one for your house, one for your stocks, one for your whatever?
Yeah, it depends. It depends, yeah. I hate saying that, but it's very true. It depends. I have families who have 7 rental properties and have 7 trusts for each rental property. I have families who have 7 rental properties and 1 trust, so it just depends on liability and risk, and those are good conversations.
Beneficiaries are supposed to take care of that, like you mentioned, the house is in the name of your brothers or something like that. Isn't that enough?
I'm not sure if I followed. I apologize.
It depends.
Yeah.
Beneficiaries for some, your stocks or, I don't know, whatever.
Yeah.
Isn't that enough coverage?
Well, like he said, sometimes when you have a beneficiary and the asset passes directly, it may bypass probate. But again,
It may not.
It may or it may not. Love those answers. I
Yeah.
give them myself. But again, in his story, that asset transferred directly to the grandchild, and the grandchild was going through a situation that nobody would have timed.
And the grandchild would have to pay, or don't they have to, especially with IRAs, or is it everything? Have to.
Well, you always have to pay, in a retirement account, when assets are pulled out, you always have to pay the IRS. It just is more dependent on a strategic way of when and how you pay those assets that we can help with. Yeah.
And in that case, he had to withdraw everything at on the front end, so that's why he got hit with the whole taxable amount in 1 year.
So it's a great point. I have a lot of families who come to me and say, oh, no, I've got beneficiaries set up to my accounts, and I'm fine. Well, I say, are you? If we had a crystal ball, I'd be out of the job. But having a better way to protect and shelter those assets covers all the ifs, ands, and buts, and that's through trust.
And there's a balance to any sort of tax planning, estate tax planning, income tax planning, all of that. There's a balance between practicality, protection. You want to make sure you're utilizing the strategies available to you, but you also want a strategy that is simplistic enough that you can use it and understand it, and it's meeting your goals. And so I tell this all the time to my business owners, my individuals. I might have 1,001 strategies to use, but maybe only 50 make sense for what you want to do and what your strategy is and what your goals are. I don't want to overcomplicate your tax situation where I'm filing 15 tax returns because we're putting things in different LLCs or different trusts or whatever the case is. We want to make sure we're giving you the most efficient tax strategy, structure for both your personal, your business, whatever the case may be, that protects you, protects the future generations, but also has a usability to it and an understandability to it, because ultimately it's the next generation that has to sort through all of these documents and make sure that they're being executed the way that you think they're going to.
This is a very quick two-part question, but I was curious, when people come to you and they decide that they want to do charitable giving in some way, shape, or form, do they, one, know what nonprofits generally they want to give to? And if they don't, what are the things that you think about as far as how you advise them and the types of nonprofits they should give to?
So it depends. I almost said that, but it really comes down to their passions, right? Oftentimes I'll sit with a client and we'll have the conversation around what's important to you. and we align. If they don't have something that's important, that's the beauty of an organization like the Community Foundation, is there's buckets within the organization. I mentioned the Women's Fund. There's a Men's Fund as well. There's options. I've had the opportunity to sit on the board as a trustee for, I think, 5 years now. And we had a gentleman that did all of his estate planning, had no children, had no other beneficiaries. His entire estate came to the Community Foundation. It was kind of spread out over different places. So it comes down to what people are passionate about. My clients have worked extremely hard to build their wealth, and we want to make sure that that wealth transfers in a manner that that's most important to them and aligns to their passions. So it's a good question, because it really comes down to client.
Yeah, and I'll add to that before I apologize. Yeah, as I go through my process with the families that I work with, I have an initial consult, get to figure out what they're trying to accomplish, and then we have what's called a design meeting. In the design meeting is where we hammer out a lot of the details of what we put in the documents. And as I had mentioned, seeing things that you can't do with simple beneficiary designations, you can put a lot of beneficiaries, contingent beneficiaries, to a trust. And so part of that conversation is all right, we've got the kids, we've got the grandkids, all right, now if, God forbid, I call it the disaster clause, God forbid there's no kids, there's no grandkids, who do we then want assets to go to? And a lot of times that's when the conversation of charities and organizations come up. And yeah, Chad hit the nail on the head is, hey, what are you passionate about? A lot of times they have somebody they know or like, but what are you passionate about? And then if not, the Community Foundation, I direct them to the Community Foundation, and that's somebody that can help with that as well. And then we implement that within the estate planning documents. So, yes. Yeah.
Just as a follow-up to that, how do you advise clients on that? So let's say, they're coming to you, they're looking to identify a charitable organization, maybe they don't have somebody in mind. Do you advise your clients based on relationships that you have with charitable organizations? Are you helping them do research on organizations within a particular geography or audience that they are aligned with? I feel like, I've worked in the charitable space for a long time. I always feel like there's kind of a gap there between, the folks who work for charitable organizations and the people who maybe are advising people who don't have a relationship with someone.
So I can share what my process is. Katie might have one. Collin might have one too. I'm happy to start there, and then you two want to build on it. That's great. So I believe part of my role as an advisor is to build relationships in my community. So certainly, if they have something that wants to be more Rochester community focused, right, or my practice is in Rochester, I live in Romeo, right, so those are two communities I'm passionate about. So it's going to start there with the relationships that I've built, but I think it's important that we get out of our chairs and get out in the community and get to know people. And then if it's bigger than that, we're going to work together on finding something. So I'll work my network first.
Yeah, I think a little bit of, not personal bias, but our own personal networks of who we've talked to and who we know, or a friend of a friend of a friend, goes into it. But the conversation always starts with, what are your goals? What are your passions? What do you want to look for? And sometimes I'm Googling. I'm Googling local charities who are doing X, Y, and Z, because sometimes I don't know. So for me personally, I like to get involved with groups that maybe do a charity forum or things like that, where I get to see, 15 or 20 different charitable organizations that have a showcase or things like that, because there's so many charitable organizations around that do amazing things, and it's just staying educated. Just like we have to stay educated on the law and the changes, keeping connected to our communities and what's important for our clients. I will say most of my clients come to me with a charity in mind, with somebody in mind, and that's when I have to go in the database and say, I'm sorry, your child's elementary school is not a charitable contribution. You cannot write off the lockers that you just paid for. I'm really, really sorry, but that was very nice of you. Most of the time they come to us with an idea or a name, but it is one of those things that we want to make sure we're pointing them in the direction that they're passionate about and serving them.
Yeah, and I'll keep mine short. I mean, you don't know what you don't know, so we're always open to listening and introductions to new people, but that's also why we're here, too. I mean, yeah, it's a good point, but that's why we're here.
Did we get the second part of you said it was, okay.
Well, just real quick, based on that, where do you go to look as the person looking for to find out if they are a qualified charitable organization?
There's the IRS lists all their 501c3. So
GuideStar's a really
GuideStar.
good one.
I
too.
bet their website probably says it as well, I would think. You know,
Yes,
like
any qualified organization will make darn sure that they list that they are a qualified organization.
Yeah, good question.
Is there any, if you have a qualified charitable organization and you want to move money out of your required minimum distribution, are there any rules that would disqualify that charitable organization from receiving the R&D, such as a benefit? A charitable organization provides a dinner.
Oh, like specifying what it's for, you mean, like, or?
I don't see that with QCDs.
So I have not experienced that because it typically goes right to the organization, and then you can denote on the check that, an easy example, so the library has a fund at the community foundation. So that it could be sent to the community foundation, and it has to be to a fund within the community foundation. So in that case, it would go to the library. A church is another easy one, like churches do benefits. My kids go to St. John up the road, and I'll have Joe answer in just a second, so.
Great question, and you're correct that there can be no benefit in exchange for a qualified charitable distribution.
So they can't buy you dinner.
In that case is, give $9,000 out of your IRA and pay $1,000 for 2 dinner tickets or a sponsorship or something like that. But it's a great question, and you do want to be careful of that because we get distributions from Fidelity or Schwab, and it will say on there that I have to certify that there is no benefit coming to the donor.
Yeah, so maybe 6 months later or something, there's a dinner or a gala or something like that, and you just get invited because you're a community member. 2 separate transactions, completely disjointed. Now, I will get charitable deduction letters that say, thank you for your $1,000 gift. In exchange, you received a $50 dinner. So, I will take that into account. But on those letters that people get that are very, very important to keep and give to your accountants, we like those. We like letters. The organization is required to disclose if there was any services or benefits received in exchange for that. So, I've never seen a QCD where there's been an issue.
How does that relate to the annual gift tax that you were talking about?
It's charitable organizations are excluded. Yes. The annual
gift tax.
How
does that work in the sense of your taxes?
Yes. So let's say I win the lottery. Just talk. And I could give everybody in this room $13,000. Let's just go with. It changes every year for inflation. It's per person per year. So I could give my my mother $13,000. I could give her $26,000 and say I split it between me and my husband and really not give him any choice about it. But there is an annual exclusion, and so if you give cash under or at that amount, you don't need to file a gift tax return. Cash. If you give cash for that amount, you don't have to file a gift tax return. Per person. So I could give it to everybody in this room. That money leaves my estate, and it just.
And remember, per person, so if she's married, she can give 13.5. Her husband can give 13.5. 13.5, 13. Yeah. Yep.
Yes. So I could give somebody 27 and split it with my husband, and I'm under the exclusion. Everybody's happy.
So you're telling me that if I gave a grandchild $15,000, that I would owe taxes on?
Are you married?
No.
Then yes. Well, no, I'm
Just
sorry.
the over amount.
Just the 15.
The
And it goes
overage goes towards your
Yeah.
lifetime
Yeah,
exclusion.
which is very high.
It, again, just change. It's $15 million. So any overage would go towards that $15 million. So you will not be taxed until you exceed
Correct.
both your annual limitation, your lifetime limitation, and then it goes all the way over to the side.
So
I know it's super complicated and there's a bunch of stuff that goes into it. Yes. We record it on a separate tax return.
So it's easy for me to say it from my perspective because, yeah, that was kind of relating to my work. A lot of families come to me with tax concerns. However, a lot of times, from my perspective, we throw it out the window. And the reason being is because it just does the inheritance tax threshold, you know, there's not a lot of taxes from my perspective that affect people with over, you know, unless you have over 13 million and a half per person or so. Totally different than, you know, taxes get a big name. There's property taxes, capital gain taxes, income taxes, inheritance taxes. So again, there's a lot going on.
I did not create these taxes. I just help you sort through them. I did not do it, so.
All right. Well, I think we're going to wrap up because we're out of time, but I just wanted to make some final remarks. Just to keep the Community Foundation in mind when you are developing your charitable intents. Jo is an amazing resource in this community. We are so lucky to have her. So she doesn't promote herself well enough. But I wanted to give you a couple examples. I based these on the people that are here and the questions that you submitted. So a couple examples of how we worked with groups in the community. Community Foundation recently assisted a family foundation belonging to long-term donors that are aging and moving out of the area. The result has been 10 donor-advised funds that will be managed by the Community Foundation, working with members of their family and friends to distribute the available funding each year as they desire. So in other words, they didn't have somebody that wanted to take over this family foundation, so they passed it to the Community Foundation. We're still honoring their wishes, we're just doing it in a different way. And so second example is, years ago, a retired local teacher established a scholarship fund at the foundation to support a scholarship for local high school students. She directs part of her annual IRA required minimum distribution to fund this scholarship, and it qualifies as a qualified charitable distribution. So those are some examples. I just wanted to give you some examples, real life examples. So among our many goals, the Community Foundation, one is to encourage families to consider beginning family legacy funds that can be a means of families to share in the feeling of giving back and see the impact that can be made. That's a really exciting thing, is to involve your children and your grandchildren in charitable giving and establishing a fund. I saw a local foundation do that, and I thought it was such a neat thing where they had their grandchildren picking the charities and doing the research and pitching their grandmother and their parents on those organizations to pick. It's just a fun thing to do together, and you're giving back. We're a very blessed community, so it's really actually quite a joy to give back. I'll get off my soapbox. I did put a brochure about the Community Foundation on your place setting there. We offer many ways to meet your philanthropic goals, whether it's to support your favorite nonprofit, honor a loved one, or create personal legacy. So with that being said, we're going to close. We'll still be here if you have questions, but thanks so much for being here.
Thank you.
Thank you, guys.
Thank you all.